Hi everyone. There is a happy news for you on taxation in the UAE. Happy news on tax? Yes, happy news on tax. What is that? If you stay just 90 days in the UAE in a year, you will become a tax resident in the UAE. Yes, stay minimum of 90 days in the UAE and get tax benefit of 0 rate on your income and in some cases on your global income as well. In today's video, we will be understanding to whom this new rule is applicable and what are the benefits one can get on their global income and what steps one should take to get such benefits. I am Manu with you. What I do is simplify tax for you. Welcome to Emirates Chartered Accountants Group, ECAG. Recently, the Ministry released the Cabinet Decision number 85 of 2022 related to determination of tax residency in the UAE. The most important point applicable for a natural person, that is individuals like me and you, are mentioned in the article number 4 of the decision. As per this article, an individual becomes a tax resident in the UAE in 3 situations. Situation number 1, if one person usual or primary place of residence and the center of his financial and personal interests are in the UAE. It means that persons who predominantly reside in the UAE maintains his personal assets in the UAE and also has family living in the UAE, then he will become a tax resident of the UAE. In this case, the number of days of stays in the UAE is irrelevant. This situation is mostly applicable in general for the UAE nationals in practice. Situation 2. If one person is physically present in the UAE for more than 182 days during a period of 12 consecutive months, he becomes a tax resident in the UAE. This is the commonly accepted residency criteria globally and also recommended by the OECD. Now, situation number 3, very important and interesting for us. Any person like a UAE national or an expatriate who holds a valid residence permit in the UAE or a GCC national, any one of these 3 categories of people who is physically present in the UAE for a period of just 90 days during a period of 12 consecutive months, then he will also be considered as a tax resident in the UAE, provided he satisfies any one of the 3 conditions. What are the conditions? Either he should have a permanent place of residence in the UAE, or he has a business in the UAE, or he is employed in the UAE under an employer. This is very interesting clause and has vast impact. I will explain it in simple words. If you have a permanent residence in the UAE, permanent residence doesn't mean that you have to have own property, even a rented apartment is enough for that purpose. Or if you undertake a business in the UAE or employed in the UAE and stays for 90 days in the UAE, you will be considered as a tax resident in this country. What is the tax rate applicable in the UAE for an individual? There is no tax. There is no personal income tax. That means you need not pay tax. Hence, what will be the tax applicable for you on your global income? Probably 0. Very interesting, right? Hold on. Before concluding that, you should check whether you are resident in any other country as well during the same financial year or not. If you are resident in any other country, check whether UAE signed a double tax avoidance agreement with that country. UAE has signed a double tax avoidance agreement with more than 130 countries as of now. If there is such an agreement with your country, determine the tax residency as per the double tax avoidance agreement, and if you constitute a tax residency in both the countries, apply the tiebreaker rule and fix the country where you are a tax resident and apply the taxability accordingly. For your better understanding, I will explain it with an example. If you are from a country, say Israel or Ireland, and stay in the UAE for more than 90 days and satisfy any one of the conditions discussed earlier, such as an employment in the UAE, or have a business in the UAE, or have a permanent place of residence in a residence, that is home, in the UAE, still you may not be considered as a tax resident in the UAE, because as per the double tax avoidance agreement between UAE and your country, for this example Ireland or Israel, you should stay in the UAE for 183 days to be considered as a tax resident in the UAE, and the condition of 90 days stay will not be applicable or will not be sufficient in this case. At the same time, UAE KSA treaty refers to the local law to determine the tax residency. Hence, in this case, in the case of KSA, even 90 days stay in the UAE may result in tax residency in the UAE. To summarize, in order to determine the tax residency, one should follow the following steps. Number 1, check whether you are a tax resident in the UAE as per any of the 3 situations as per the cabinet decisions number 85 of 22 on residency in the UAE. Step 2, if yes, if you are a tax resident as per this decision, check whether there is any chance that you probably become a tax resident in any other country during the same period. Step 3, if you are a tax resident in any other country, whether UAE has a DTAA with that country or not. And step 4, if the answer is yes, that is a DTAA is there between your country and UAE, check the criteria of tax residency as per DTAA. And step 5, if still you are a tax resident in both countries, apply tiebreaker rule and fix it. So, it's important that you should analyze DTAA and the foreign jurisdiction as well, along with the UAE tax residency decision, to determine your tax residency in the UAE. Hope now you understood the applicability of the tax residency rule in the UAE, and still if you need any further clarity on it, please feel free to contact us. Goodbye.